Hey everyone, welcome to The Explainer. Today, we're diving into a topic that literally dictates the products you buy and the brands you interact with every single day. We are talking about massive, multi-business corporations. Think of these mega companies like master jugglers. Seriously, they aren't just tossing around one or two balls, they are keeping dozens of entirely different businesses up in the air all at once. And in this explainer, we're going to uncover exactly how they pull it off. We'll explore how top executives make their absolute biggest structural decisions and how they manage these massive empires for maximum success. Okay, let's take a quick look at our roadmap for today. We've got 5 main stops. 1. The hierarchy of strategy. 2. Defining corporate-level strategy. 3. The drive to diversify. 4. The portfolio management approach. And finally, 5. Balancing the business portfolio. Let's get right into it.
All right, starting with Section 1, the hierarchy of strategy, the big picture. When we break down an organization, we essentially find a 3-tier cake of strategic decision-making. Right down at the bottom, you have the functional level. This is your R&D, your marketing, finance, human resources, the folks handling the day-to-day operations. Take a step up, and you hit the business-level strategy. That's focused on how a single division competes in its specific market. How to actually win against direct rivals. But look at the very top. That's the corporate-level strategy. Notice just how far above the daily grind those corporate executives actually sit. They aren't sitting around figuring out the marketing plan for a single product. They are looking at the entire umbrella, managing the overall direction of the whole company.
Which brings us to Section 2, defining corporate-level strategy, the view from the top.
So, what does corporate strategy actually boil down to? It's really just one massive foundational question. What businesses or industries should the firm compete in? It's completely zooming out. It's not about how to sell a single product. It's deciding if the company should even exist in a specific industry at all. This level of strategy establishes the total direction of the company and dictates how top management oversees its whole portfolio of businesses. Let's look at an example to make this concrete. Take McDonald's, right? We all know their core business is fast food retail. But imagine if they decided to enter a completely new industry, say manufacturing kitchen equipment, and on top of that, expanding into a totally new geographic market like China. That is not just some simple marketing shift. That is a huge diversification strategy orchestrated right at the highest corporate level by the CEO, and it completely changes the entire shape of the corporation.
Moving right along to Section 3, the drive to diversify, growing the empire. Now, you might be wondering, why do these successful companies rarely just stick to doing one thing? Well, the ultimate goal of corporate diversification is building shareholder value. And the absolute magic word to achieve that? Synergy. Synergy means creating a multi-business company where the whole is literally greater than the sum of its parts. It's that classic 1 + 1 = 3 effect. If a company buys another business, they don't want the two businesses to just perform the same as they did independently. No way. They want that combination to generate an entirely new level of competitive advantage and profitability.
Basically, companies take 2 main paths to get this kind of growth: related versus unrelated diversification. In related diversification, the businesses share operational similarities. Maybe they share the same technology or supply chains, or they leverage a powerful brand name to create a cost advantage. Unrelated diversification, on the flip side, is when a company buys businesses that have absolutely nothing in common operationally. In that case, the headquarters is functioning way more like a pure investment holding company. They're seeking value solely through smart financial allocation rather than, sharing a factory or a marketing team. But executives can't just go on a wild shopping spree and automatically expect success. For a diversification move to truly add shareholder value over the long term, our sources emphasize it absolutely must pass what's called the 3 tests of corporate advantage. Step 1 is the industry attractiveness test. Basically, the new industry has to have solid growth and profit potential. Step 2 is the cost of entry test. You can't overpay for the acquisition to the point where it just wipes out your future profits. And step 3, which is absolutely crucial, is the better off test. The businesses must perform better together under the corporate umbrella than they ever could apart. If a move only passes 1 or 2 of these tests, it's highly suspect and probably a bad idea. All right, Section 4, the portfolio management approach, the internal banker.
This brings us to a really fascinating metaphor from our sources, the idea of the internal banker.
In a multi-business company, the corporate headquarters views its various business units basically as a basket of investments. Just like a banker would, top management's job is to constantly juggle these investments, evaluate the risks, and allocate capital to the ones that are going to provide the very best long-term profitable return for the entire corporation. And if you want a true masterclass in unrelated diversification and portfolio management, look no further than Warren Buffett. I mean, he has built Berkshire Hathaway out of 65 mostly unrelated acquisitions. How? By acting as the ultimate portfolio wizard. His success relies almost entirely on his incredible ability to spot undervalued companies, doing it way better than the stock market does, and then acting as that highly efficient internal banker. He allocates capital among all those wildly different businesses way better than the broader financial markets ever could. And that leads us into our final stretch. Section 5. Balancing the business portfolio, the Juggler's Toolkit. So to maintain this perfectly balanced portfolio, companies use tools like the BCG matrix. Think about it like this. On one hand, you have high-growth products. They have high market share in a really rapidly growing market. These businesses are exciting, they are the future, but they desperately need massive cash inputs just to keep growing. On the other hand, you have what are called cash cow units. These still have high market share, but the market growth has slowed way down. Because they're already established, they don't need heavy investment anymore, so they just reliably generate excess cash. The internal banker's whole job is to harvest the free cash flow from those cash cows and inject it right into the growth businesses. To ensure the balance stays perfect, management has to make some pretty tough, decisive calls. They might broaden their base by acquiring brand new companies, or they might just stick closely to what they already have if it's humming along nicely. But importantly, they also might retrench. That means they sell off or divest competitively weak businesses that just don't fit the puzzle anymore. By divesting the weak units, they free up a ton of capital to redeploy into more promising ones. It's this constant state of structuring and restructuring. It's exactly like how you would actively manage a personal stock portfolio, all to ensure the whole corporation thrives. A totally brilliant real-world application of this concept is Disney's profit multiplier model. Think about it. Disney doesn't just make a cartoon and call it a day. They use the power of synergy across their entire portfolio. A single cartoon character becomes the foundation for high-margin theme park attractions, endless merchandise, and super lucrative licensing opportunities across a dozen different divisions. They act as this incredible corporate parent, turning isolated assets into a massive, interconnected portfolio that generates way more value together than those pieces ever could apart. All right, that brings us to the end of our explainer. But before we go, I want to leave you with a bit of a mind bender to consider. The next time you buy a product, take a second to think about the corporate structure behind it. As these multi-business corporations quietly juggle massive internal investments, moving cash from one division to fund another, are the everyday brands you interact with actually just tiny cogs in a massive hidden corporate portfolio? It really completely changes how you look at the business world, doesn't it? Thanks so much for joining me for this explainer, and always keep questioning the strategy behind the brands you love.